at 4 p.m. We have a variety of different webinars coming up that we're hosting, and you can check your email for details on those. To get started, a direct quote from Loreen is, "We help our clients integrate their values and their wealth so that their wealth and their values outlive them." The subject of responsible investing is in alignment with that statement, and today's webinar will be all about aligning your financial goals with your values. If you have questions throughout this webinar, please email them. Don't use the chat feature. You can email those to loreen.g@wealthwisefinancial.com. So now we'll go ahead and get started. I'd like to introduce Loreen Gilbert, President and Founder of Wealthwise Financial.
Thank you, Annie. It's great to be here another week of doing these webinars. And today our topic is environmental, sustainable, and governance investing. And we're going to dig down deeper into what that really means. And we have Eaton Vance here hosting this and helping us out with it. Before we get into our subject of the day, I also wanted to announce that next week we're going to be talking about charitable lead trusts and donor advised funds and why they're so valuable, especially right now with the current low interest rates, as well as the CARES and Secure Act, and how these can benefit you. So be sure to tune in next week at the same time for next week's webinar. Also, I also want to mention that we are recording these webinars. We then have to get them through our compliance department, but once they're through that compliance department, we then post them on our website. So if you've missed one of them, or you want to go back and you want to hear it perhaps in more detail again, you can go to our website, wealthwisefinancial.com, and you can find, we now have a tab that says webinars on there, and you can take a look at that. Also, if you have a topic that you are interested in, please let us know. We are putting together these weekly webinars for your benefit, our clients, and we certainly want to be talking about topics that are of interest to you. So please let us know if you have any interesting topics that you'd like to hear about. And then finally, as Annie said, if you have any questions during the webinar, please email me. I'll be looking at my email throughout the presentation, and we'll be answering questions at the end. And you can email me those questions at Loreen, L-O-R-E-E-N-G, @wealthwisefinancial.com. With that, so now that's our intro. With that, let me introduce Dory Hedrick, who is our Eaton Vance representative. Oops, let's make sure everybody is on mute. So April, if you'll make sure that everybody is muted, that would be great. And then Dory, introduce you. Thank you for your support, and go ahead and make the introduction to Andrew.
Excellent. Thank you so much, Loreen, for having us today. And it's a pleasure to be on with all of you. I'm really excited to bring this topic and bring our featured speaker out to all of you. I get the pleasure of introducing Andrew. Andrew Oleg is a Vice President and Responsible Investment Strategy Specialist for Calvert Research and Management. Calvert is a wholly owned subsidiary of Eaton Vance Management, and they specialize in responsible and sustainable investing across all global markets. So he's responsible for all of our strategies focused on responsible investing across all asset classes, and he'll explain to you what exactly responsible investing is. He's responsible for client and internal communications and insights on investment strategy and portfolio positioning. He's been in the investment management industry for 20 years and joined Calvert back in 2016. In addition to holding all of his investment licenses through FINRA, he also holds the Chartered SRI Counselor designation, and he is in a group of leading industry professionals to earn the FSA credential, designed for professionals who benefit from understanding the link between material sustainability information and a company's financial performance. Andrew lives up in the Bay Area with his wife and 2 kids. So like many of us, you can also add teacher and daycare provider to his resume this year. It's my pleasure to turn the virtual stage over to Andrew Oleg.
Great, wonderful. Well, thank you. That's a great introduction, and I really appreciate it. And thank you all for taking some time to join us. I'm going to try to share my screen here. as I tee up this presentation. Hopefully this will work for you. What the idea would be to talk about today, which is really arguably one of the fastest growing parts of the global financial services industry, bar none, when we talk about responsible investing. As Dory mentioned, my job is really kind of twofold. I work with advisors and consultants in messaging what's going on with the whole landscape and behind the scenes on how to really put responsible and ESG information into play into a portfolio. And then I also work with the advisors and consultants on portfolio construction to really help tailor it. What we'll talk about today is that when we started at Calvert over 40 years ago, it was really kind of a one-size-fits-all type of approach. And today there's many more tools in your toolkit as an investor to really diagnose what an investor wants to explicitly entertain in their investment portfolio or not entertain, highlight or avoid. And we can do that in numerous different ways today in 2020 versus what we could have done even 5 or 10 years ago, let alone 42 years ago when we started at Calvert. For those of you that don't know Calvert, I'll talk a little bit about what we do as well too. Now, we are not the only game in town, clearly. We are one of a handful of dedicated responsible investment shops that it's our core focus. We are a pioneer in the space, so we've been there from the start. And we cover a lot of ground, and so we have been looked to as an authority in the space, and that's why I can talk to how we look through the world, as we've been really part of the foundational beginning of responsible investing, and we've helped steer it and been in kind of a leadership position up until where we're at today in 2020 and beyond. That being said, though, we have some great competitors, I guess, or you could say friendly competitors that do great work as well too. And if we want to get into contrasting and comparing, we can do that with Q&A. So happy to talk to that as well. So the idea here today is really to talk about a couple of things. What's the investment landscape around responsible investing? What's driving it today? What are some of the trends that investors should be aware of? And again, I mentioned I'll talk a little bit about our unique approach at Calvert to really give you some perspective on how we think through our dual mandate of changing the world, making the world a better place, but also doing it in ways that really make sense from a portfolio construction perspective, always bringing it back to what is the investment outlook or return generation that we can expect from doing this kind of work. Hopefully that makes a lot of sense. And please, if there's questions, Loreen, Dory, if you guys want to interject with questions that the audience has or that you have, please feel free. These are 20 or so slides on prepared comments, but we can jump in at any particular time. And I know, Loreen, you mentioned that you have really seen an uptick in interest in this particular style of investing with clients. So I don't know if there's anything that you wanted to start with.
Yeah, I'll just start with the fact that this is certainly a growing area of market and clients, and that is wanting to know that their money definitely it's of interest to us. And I do want to say that we have constructed portfolios with this in mind. So we have constructed portfolios. We have constructed separate portfolios specifically around questions about that. We talk about that. If you're interested in this style of investing, then we can talk.
That's great. Well, I think that's a great tie into what's driving the investment landscape today. And on this slide, can everybody see that? Can you see the slide here with headlines?
Yes, we can see it.
Wonderful, thank you. Well, let's start on the right-hand side and just talk about what's happened over the last couple of years with major pharmaceutical companies. We invest at Calvert in pharmaceutical companies, but we think health is a very important priority, especially given what we're going through today with the global pandemic. But as it pertains to an investor and as it pertains to an environmental or social reason to either invest or not invest in certain companies, there's certain pharmaceutical companies which we have avoided in our investment universe for a few years, specifically because they have product safety issues around talcum powder going back to really the 70s and 80s and not cleaning up those practices. And those same companies having ties to manufacture and distribution of opioids and pharmaceutical opiates, which has really put communities and states, let alone investors, really behind the eight ball when you think about it being a real prevalent problem across the United States that really knows no bounds. Rich, poor, educated, uneducated, men, women, cross demographics. Pharmaceutical opioid addiction is a real problem. And when you parlay that with the fact that states are now litigating certain pharmaceutical companies, the investment outlook, had you owned that company, had you not avoided that company as an investor, could be really challenging. And so just a quick example there as we kind of move left, think about inequality, and we're talking about gender inequality, top on the right here on the top, but that dynamic is also kind of morphed over the last couple of weeks as we've seen to racial equality, and how do we build that into our practices as an investor? How do we urge companies to make better decisions to really lift up all demographics of not only consumers, but people that they could employ as workers? In the middle, you see an example about a health data company. A lot of data breaches over the last few years, whether it's in healthcare or in IT or Capital One. You might remember a couple of years ago, Equifax, another company that we dropped from our universe about 18 months before 140 million Americans were subjected to a data breach. And we had recognized at Calvert a pattern of lax protocol. And so we said that this company just isn't strengthening its security protocol, a real risk to them from a social perspective. That's an S pillar, which we'll get into in a minute. And so we moved away from them. And then you can think about healthcare today. How do we treat our workers? How do we treat our customers? Companies stepping up to really provide response. And so there's a lot of different ways that these environmental, social, and corporate governance themes and ideas can really materialize themselves in useful ways as an investor to understand where you want to allocate investment or where you want to avoid investing on behalf of your clients. So hopefully that makes sense, just to kind of set up the framework here. The other thing that's really grown over the last few years is that companies, now especially large brand name leading companies, are really starting to step up and take notice and take credit for having great sustainability practices. Every February over the last 3 years, Barron's actually publishes a list of the 100 most US sustainable companies. We can get you a copy of this. It's something that they tap into Calvert's research system to really build out, to show that sustainability is important across sectors and across company types, but it also lists some of the companies that are the most sustainable compared to their peers. More importantly, as of last week, out of this particular 100 most sustainable list that came out in February of this year, I've seen no less than 37 press releases from companies taking credit. Hey, we're a sustainable company. We have sustainable practices. It helps them in recruiting. It helps their stock price, surely. So there's ties to kind of balance sheet information, but also non-balance sheet, but more important, branding information by companies really taking on some of these sustainability challenges and thinking about what's important to them. When we think about a global framework to address certain challenges, you may or may not be familiar with what's called the United Nations Sustainable Development Goals. This was put into place in 2015. And the interesting thing here was the Sustainable Development Goals historically were put in place by non-government organizations and governments to think through, how do we mobilize and move capitalism forward in a way over the next 15 years, the next couple of decades, in a way that doesn't sacrifice our finite resources, in a way that doesn't sacrifice our environment, but also tries to lift more people up, really taking into account growing population sets, but really thinking through access to healthcare, access to information and education to lift people out of inequality so that they can really participate in the global economy. These sustainable development goals have become somewhat of a framework for how we as impact investors or responsible investors would measure or juxtapose our investment in certain areas. And it's actually done some good work to really look to a portfolio to build out impact metrics. So you can compare, and we'll get into this later, a responsible investment compared to a traditional benchmark like S&P. And you can look at the investment outcomes, but you can also look at the environmental and social outcomes of both types of investments to try to weigh your decision as an investor. And these are things that weren't even around 2-3 years ago. So I think that's what's going back to what Loreen said. This is helping to really drive the growth in this particular space.
Yeah, and Andrew, one of the additional points I'd make right here is that a lot of people say, yes, I want to know that my investing is doing good, but I also want to know that I'm doing well. And there's no longer a contradiction there. In other words, you can invest in responsible companies and still do well in your portfolio, and we'll show you some of those numbers.
Yeah, absolutely. A great preview to where we're going. I think probably the three biggest drivers to this space are, number one, kind of a global recognition that companies, from a social license to operate perspective, better be thinking through these things from a branding perspective. Second, I think there's more information and data sets. I'll show you something in a little bit. There's just better information sets today that we have on how companies behave that can lead to better outcomes for an investor, right? And those both of those kind of realizations tie to clear performance link between thinking through portfolio construction around the things that matter around sustainability and driving performance for an investor. So yep, absolutely. Take a step back and talk a little bit about some nomenclature, or how are we going to level set from a perspective of what does it mean. Responsible investing is a global term. So it used to be called, when we started at Calvert, socially responsible investing. We went through another iteration where it was called sustainable and responsible investing. We've kind of dropped the S, and then the global term is just responsible investment. And it takes into corporation really things that used to sit off of the balance sheet to really look at companies and be able to stack rate companies in a way to understand their environmental, that's the E, their social, that's the S, and their governance, corporate governance factors which drive their performance. And as I mentioned, these things used to sit off the balance sheet, but it's interesting, it's estimated that about 80% of the value of the market today, when you look at the US market or the non-US developed market, like the MSCI EFA, about 80% or 80+% of the value of that marketplace is intangible. It's not a tangible asset like it used to be in the 50s or 60s. It's licensed to operate, it's trademark, it's patent, it's response or view from a customer and client perspective. You'll also hear this term continuing to grow out of what we've seen over the last quarter, of the idea of a share owner versus a stakeholder. And a stakeholder takes into consideration not just the owners of shares, but the community which you operate in. Where does the city or town where your mailbox is think about your operation, or where your engineer is? What do your clients think of you? How do your employees think of you? All of these things used to really be kind of sitting outside of the balance sheet, but today we can actually price them into an equation to understand risk and opportunity from a company perspective. We've done it for quite some time around the E piece of things: energy management, water use, how much waste you create, because eventually, and there already has been, a growing tax or cost to some of those negative environmental outcomes from a company. You create waste, you create greenhouse gases, you have to pay, and I think this will continue to grow as we see some form of carbon taxing. And so companies that aren't measuring this and managing this could really put their investors at a disadvantage. From a social perspective, it's a big and growing bucket, but think about product safety. I mentioned pharmaceuticals, I mentioned cybersecurity if you're in IT. You can think about even product safety from an automobile manufacturer? Do they have recalls? That can be costly to the consumer and costly to the company. And more importantly, some of these things that, again, how do we take care of our employees? What kind of programs do we have in-house to attract and retain some of the best talent? And then governance, how do we structure the company? Do we have diversity at the corporate level? Because the numbers are in. We've always thought this at Calvert, and we've always invested accordingly, but we have nice, shiny reports from consultants that tell us that if you have diverse set of thoughts at the corporate level, it leads to a much better operation, and it's a more friendly investment. And then transparency. How do you behave? That's your business ethics. And then how transparent are you with investors to provide some of these information sets? So that's what we're looking to at Calvert and other responsible investors, to really take stock in these ESG inputs that historically Wall Street wasn't paying attention to. We always have. But I think Wall Street is increasingly paying attention to these things because you can actually translate it specifically to the outcome or the share price of a company. When we talk about responsible investing, there's a couple of dominant themes. I've touched on a few. Climate change is very important to investors. And it's interesting because it's, whether you believe in the science or not, it's really not the point. The point is as a business, there's physical risk to your plant, your property, especially if you have a plant or a headquarters in places that see more and increased volatile weather. So there's real costs associated to that. There's also transition risk in thinking through energy transition. If you're not using or building an infrastructure to use renewable energy sources, there could be penalties, as I alluded to before, to your business, or taxes that you have to pay, which would be, straight accretive to the bottom line and affecting investors. Clean technology is a very fast and growing part of the marketplace, and investors historically have said, well, how many windmills and wind farms do you invest in? And it started there, but it's really interesting when you think about some of the biggest brand names investing in and spending energy in building out clean tech, low carbon. When you think about Apple, Microsoft, Starbucks, Toyota, huge companies that are some of the biggest developers of clean, renewable, low carbon types of technology. So it's not small companies in a garage like you might think. It's big companies really shifting how they invest and where they're investing and where they're taking the direction of their company. I mentioned before, emissions and waste management will be crucial in understanding risk to investors. It is right now, and it's going to continue to grow. Human rights, we think, are across the board, no matter what kind of company you're in. Diversity, as I alluded to, matters, but also how you treat people and programs you have in place to really kind of lift up communities, I think are going to be looked to more and more from corporations, as we've seen even in this recent pandemic, where corporations by and large have stepped up to really take that burden on in place of areas where we might not have policies that agree. Corporations are really kind of leading us, and we ask them to as investors. And then cybersecurity or data security, certainly a growing awareness set. Certainly more material are important to certain parts of the industries or certain sectors. But as more and more of our data resists online, more and more of the cloud continues to be value of corporations, companies that really protect and have programs in place to really do a good job around this can set themselves aside from peers, set themselves ahead of their peer groups. As we mentioned, there's a real interest today in responsible investing, whether it's values-based or mission-aligned clients that we've worked with for 40 plus years at Calvert, or this growing set of folks that are just purely profit-seeking investors or institutions that just want to use these ESG data points to build a better portfolio, because there's a clear link, as I mentioned before, to portfolio return, towards return outcomes. And so we've built a process at our firm, and others have done this too, to really say, what is the most important ESG information for being A, responsible, but B, creating value for a share owner? how do we put that mosaic together in a systematized framework to then evaluate the entire global capital markets? And this particular brand of investing can satisfy, like I said, mission-oriented clients that we've worked with for years, but we're also seeing clients come to us that don't even have a particular mission, but say, wow, these particular ESG offerings are tending to outperform traditional offerings, and they also don't come with some of the environmental baggage that you'd have if you invested traditionally. So you get kind of a double win. So we're starting to see folks kind of step into this world, even if they didn't start with that intent. So it's very, very refreshing. We mentioned some of the trends. This just shows that there's huge growth, regardless of the type of investor that you are. Certain demographics have seen very heightened interest in having either, and this 85% shows either somewhat or very interested in having a conversation around responsible investing. So it's up year over year in just about every single demographic. Again, there's in certain demographics, millennials, Gen X, Gen Y, if they don't have a responsible or sustainable option in their 401k, a lot of them won't even participate in saving for their retirement because they just don't align. And so there's a huge opportunity set to educate investors and to continue to align their retirement dollars. Interesting too, when you think about where people spend time, energy, resources outside of work, when you think about what you might do in your community, what you think about what you might do on some of the boards or groups that you work with, many folks aren't even aware that you can align your retirement dollars along the same lines with some of the missions that you participate in with your charity or free time. So very interesting. As I mentioned, huge uptick in data. What this shows you. Go ahead. Are we there?
Yeah, can you hear me? Can you hear me? Hello?
Yeah.
Okay. I wanted to mention that we manage retirement plans.
That's great. Are you able to still hear me? I got a notice that I have low bandwidth.
Yes, I can hear you now.
Okay, great. Great. Just wanted to make sure we were still here. So as I mentioned, a huge driver to this work that we can do. Look at this chart where we are today. 9 in 10 basically S&P companies provide us with at least some base level of ESG data on their operations: water, energy, waste, personal programs in-house, where you get the ingredients that you put into the products that you sell me. A decade ago, it was 1 in 5, and so huge growth in the amount and the quality of data that we have around what companies tell us. So investors have been more and more interested to see, and that's where I think it's driven the fact that investors have said, provide us with this information or we're just not going to invest in your company. But more importantly, with this information, there's more that we can do as an investment manager to really parse out the data, stack rank companies to really understand who are leaders in some of these programs and who are the companies that either don't get it or don't care. Those are the ones that we'll move on from and avoid. So I think one of the best charts and just the ability to show much better outcome orientation for an investor based on data sets. We talked about the potential link to performance. In green, what this shows you on this chart, and these are meta studies, thousands of studies done over many different time periods that kind of roll all the way up. And what we found that only 4% of the time in stocks and 0% of the time in bonds was actually ESG negative towards portfolio construction. And again, this is just at the issuer or security level. So what this basically says is that 96% of the time, it's either additive or neutral in equities. And in a longer term investment in bonds, 100% of the time, either neutral or additive to the portfolio. What we found in equities, you have better return on invested capital, better market and accounting-based performance. In bonds, you have lower cost of capital, lower default rates, which I think is paramount. And more importantly, and we've always believed this at Calvert, and we can evidence, really tough markets like 2002, 2008, that were just very, very tough investment periods for investors across the board. ESG, or portfolios that looked at ESG scores and invested in companies with high ESG scores, tended to outperform in those really crippling markets like 02 and 08. We saw it again in the December market of 2018, a little bit more recent, but again, just a tough month as an investor where we gave back the entire year's worth of gains. And then in this pandemic, from late February to where we are today, ESG has actually outperformed traditional investing. So in these volatile periods, it's really done its job in providing a little bit more buoyancy for investors. Questions on that? I think that's a key link between material ESG information and portfolio construction. We all still here?
Yeah, go ahead.
Okay, great. So ESG's really evolved. So the ability in a portfolio to not just exclude certain industries, but to really, again, use that data that companies are now providing us with to create a comprehensive process that's robust, that looks to a set of metrics, which is more repeatable, it's more outcome oriented, and it just provides a smoother example for an investor. And so that's kind of the environment that we sit in today, where these factors really affect companies across the board. And so taking them into account really makes a lot of sense. As I mentioned, it's a fast growing trend. On the left-hand side, you see 2016 to 2018, that call it 9 trillion to 12, represents about a 38% growth in a couple of years. Interestingly enough, from 2018 to 2019, it went up 4x to 20 trillion last year. And already through March of this year, 10 trillion. So after a 4x, half of what we did the entire year prior in Q1 of this year, and albeit a pretty tough end to the quarter if you were an investor in March. So just continued growth and support for this area.
And Andrew, I want to make a note here and say that's why so many investment companies are starting to talk about ESG investing. And if you hear, even in earnings reports, you'll hear them discuss ESG as a point and how investment firms are focusing on it. Now, we know Calvert was at the beginning of this whole trend. And just to say, when investment firms look at these numbers, they know they need to be involved in ESG as well, or they're going to be left behind. Go ahead.
You're very right, and for our purposes, it's kind of a dual-edged sword. We love that there's more boats in the water, more oars, kind of pulling the boat. It does kind of create more competition for us, but that's great, I think, because it makes us continue to push forward on the research that we do. But it also lends real credibility to the space. On the right-hand side, this shows the number of strategies. Now, this also takes into consideration separately managed accounts, which are very custom at the individual level. Today, as it stands, according to Morningstar, which is the independent third party, there's about 330 sustainable either mutual funds or ETFs, and that's doubled in the last 3 years. And so a huge explosion in the inventory. and the strategies that a public investor has the ability to invest in. And so we're thrilled to see that. And again, many of them have different philosophies. And so there's really a way today to tailor that experience at the investor level. When we started, you could probably do US large cap and non-US large cap developed and corporate fixed income. And that was about it. And literally today, you can build an entire portfolio ranging from tactical cash, short duration fixed income vehicles, high quality credit vehicles, even floating rate bank loan vehicles for a rising rate environment, all the way up through small companies, mid-sized companies, and large cap companies in the US, the non-US, and even into the emerging markets now. We've also seen growing thematic opportunities around clean air, clean energy, clean water, gender diversity or gender lens strategies. And so the marketplace has really developed a full and much more robust product set for our retail investors in the United States, which is fantastic to see. Now we'll talk a little bit about our view. And again, this I think can be more of a launching pad, hopefully for discussion and for questions. We are looked to as an authority in the space. We've been at it for a long time, over 40 years. We are the second largest from an assets perspective, second largest responsible investment manager in the United States. We have 28 different mutual fund strategies ranging from, fixed income, active, indexing throughout the global marketplace. And we've also had one of the larger research teams associated with it. And these are folks that have financial backgrounds, but they also have backgrounds in climate science and data science and human rights and supply chain. So real expertise and the ability to price in these different lenses to really understand where we should or where we should not invest on behalf of our clientele. The other thing that we do from a leadership perspective is we engage companies. We have historically been at Calvert one of the noisier investors on Wall Street. Clients or investors have the ability to file a resolution to really signal management. We were the first investment manager in the history of Wall Street to file a shareholder resolution on an ESG event. It was in 1986, and it was on human rights. And to date, we've engaged in discussions with thousands of companies and filed hundreds of resolutions on things like clean air, clean water, transparency, diversity, human rights. We've even engaged companies on opioids and cybersecurity. And so really taking that leadership perspective. And last of all, we've actually had a chance to spend some time because we're based in Washington, D.C., on Capitol Hill, educating lawmakers on disclosure and information sets at the company level and engagement around what the future looks like for ESG investors. And so really taking serious our leadership perspective. Just a quick snapshot on what we've done at Calvert. It's a core focus for us. One thing I'll point out here, just because I think it makes sense to point it out, as Loreen mentioned, as it stands today in 2020, about 1,700 different investment shops across the planet have signed what you see right here in 2006 called the UNPRI, Principles for Responsible Investment. 1,700 different investment managers. In 2006, when we helped start it, Calvert was one of 12 companies that were founding signatories to this United Nations PRI. So I mentioned it goes back seriously, decades, but as we look at it, we've been there in many different leadership perspectives from the beginning and helped to shape, what this investment universe looks like. Won't spend a lot of time here, but I think what the gist of this very busy slide just shows you that ESG is not uniform across company set. It shows how when certain kinds of industries, the E might be much more important from an emphasis than the S or the G. And that's where we build bespoke proprietary models at the sub-industry level to really understand how ESG affects companies. At our firm, what we're trying to really identify is what kind of business is a company in? How does ESG affect this kind of business? And then more importantly, how is management of this business compared to all the other peers in their business? How is management executing on those ESG priorities? And so that's what I talked about, allocating to the leaders, avoiding the companies that might be laggards in certain areas, and then engaging companies that you do own. The engagement is very important to the dialogue, because as an owner of these companies, we think we can engage them not only on an environmental or social reason. Hey, you're pretty good at all of these things and we own you in our portfolio, but all the other companies in your industry have signed on to get renewable energy and you haven't. Or all of the other companies in your business have prepared a business thesis for how you're going to transition and lower CO2 and you haven't. You're a retailer and all the other companies in your business have diversity at the board level. 60% of your sales come from women, but yet you don't have any diversity at your board. We think you should improve upon these things. And so going to companies that you own and saying, we'd like to see some improvement from an environmental or social perspective, but always with that business thesis, always with that outcome, how we can improve our footing as an existing owner of those companies. So we think it's a very nice feedback cycle to really inform ourselves on what company priorities are and to understand where we can drive companies to elevate what they're doing. Proxy voting, you're going to see continuing to get more exposure because a lot of the large custodians out there, I guess just to say it fairly, they might be promoting sustainable or responsible investing, but then not voting proxies around climate change or greenhouse gas emissions or gender pay equity, even though they might have labeled strategies. We just don't think that's a very good thing to do. So check the proxy voting record of the companies that you invest in if these are important issues to you. We put up on our website within 72 hours any proxy we vote. And so investors, even if they own that common share in a different account, can vote accordingly. So we just think it's really important to vote those proxies to signal management if these are important issues.
And Andrew, can you hear me? So, what website, can you tell everybody where they can find that information?
Yeah, we have a wealth of information on our public website, calvert.com. And so calvert.com, you can find our proxy voting record. It's really cool. We've had it on there for 15 years. We can see our impact blog, where you can see research notes, 4 or 5 paragraphs from our CEO or different portfolio managers or research analysts on different topics. Really cool stuff. And then last of all, you can actually see impact metrics on certain products. So you can compare, like this one right here, I can show you, but you can see it in a more dynamic way on our website. This is an index that you see on this slide, where we've run this index for 21 years now. It's been around since May of 2000, 20 years now. Its benchmark is the Russell 1000, the 1,000 largest companies in the United States. What we've proven in green with the Calvert Responsible Index is that we've actually slightly outperformed the Russell 1000 in a short-term environment and over a much longer-term environment. So we've given you full participation in the marketplace, kind of going back to Loreen, what you said. We don't have to sacrifice return. Well, we've proven it. But more importantly, on the right-hand side, you can see, in addition to fully participating in the market, actually getting slightly better return, we've severely lowered some of the largest environmental negatives had you invested in the benchmark versus Calvert. With that, I mean significantly lowered fossil fuel reserves, carbon emissions, toxic emissions, product safety exposure around tobacco. So kind of having your cake and eating it too. Better outcomes, but better environmental and social outcomes as well too. So that's kind of what we think through at Calvert. And if we can show these impact metrics, we can kind of prove to you as an investor that we've actually accomplished the mission that we set out on for you. This is just a fully representative list of all the different areas that we cover. I think we'll wrap up here and then hopefully have time for some discussion, but a very fast growing part of the marketplace, if not the fastest growing part of Wall Street, better data, a clear tie to investment performance for an investor, global adoption as far as what's important from a top-down perspective in alignment, the ability to do this work with better information sets, and for an investor, the ability to really tailor it to what their approach might be to satisfy different investment policy statements. So, in thinking through what questions you might have, thinking about where you might want to allocate as an investor. Are there certain things you might want to avoid as an investor? Are there certain thought leadership or commentaries that you want to see how we're in alignment as an investor with certain priorities, perhaps sustainable development goals as a framework? And so a lot of different ways that we can have a conversation with investors today where before it was just, it was harder to do.
Great, thank you, Andrew. And just to remind everybody, like I said at the beginning, but you may have missed it, we've won on your interest level in this type of investing. So, Andrew, I'm going to start with some questions for you. Can you go into a little bit more detail on the advocacy piece of what you guys have done on Capitol Hill? That's my first question, is on advocacy, and then I have a couple other questions for you as well.
Yeah, you got it. So you have a bunch of levers as an investor that you can pull on. So one is the proxy vote if you own $2,000 of a share. Two, if you want to signal management, you can pick up the phone and give them a call and try to move them forward, or indicate that you might file a resolution. That's the corporate deal that we have based on the SEC, the structure. The one democratic part of Wall Street is that we can signal management. And we've always done that. And we've done that, matter of fact, that's United Nations PRI bullet point number 2, being an active or engaged owner. You have to satisfy that check mark if you want to stay credentialed with the UN PRI. The other thing that you have at your mercy, or a lever that you can pull as an investor, is policy. And so that's where we say, in the developed world, so a couple of examples that our CEO was really talking to folks in a Senate banking committee last April, just over a year ago, on disclosure. And his kind of drop the mic closing statement was that US companies are not disclosing to the same degree that developed companies are in other parts of the world. And if we don't adopt some kind of a framework to disclose, like what are we talking about today? EEO, and how do we treat different groups of employees in our workforce, right? There's a big call for disclosure around that. Greenhouse gas emission disclosure, science-based targets disclosure. Other companies in the developed part of the world are really adopting disclosures much more ahead of us. They're mandated to. And so his kind of his thesis was that we could put ourselves in the US as almost a sacrifice of competitiveness if we don't disclose like the rest of the world does. And then the other, one other example, think about investing in the emerging markets, which we do. Going in at the policy level in areas that might be more susceptible to corruption and bribery and things like that, to engage at the policy level to really put into the framework a way to treat investors and share owners as equals, because in some of those other communities, they're less interested in share owners when they're state-owned companies. And so you're really kind of thinking through global norms in certain parts of the world that just aren't to where we are as a developed country. Hopefully that gives you a couple examples.
Okay, great. And could you talk a little bit about privacy and what efforts you guys have really use your leverage with on this whole area, because privacy is such a huge concern in today's kind of virtual world, and people want to know that they still have their privacy. Can you talk about that?
Yeah, it's interesting. We're part of a group called the GNI, the Global Networking Initiative. And probably 3 years ago, I was down just south of where I live with our research folks at LinkedIn's campus. And just about every company that's in that Silicon Valley area, general counsel and folks in their legal team were there talking through, they were signatories of this GNI to really band together as an industry to kind of figure out, what we were talking about at the time was right to privacy, data security, but then really potential human rights abuses in other parts of the world. When a country says you can put your satellite up over here, go ahead, but then when we want to dump so and so's information because he or she is part of a targeted list of people that we want to investigate, how do these companies justify being able to kind of say no to some of these governments because they want to protect those human rights of those people and don't willfully just blindly give over that information? And so we've seen progress in that community. I think certain companies, like, I'll give you an example, Microsoft, when you think about their business, they're in the communication services business, and we rank them #1 in data security and cybersecurity because they really have some of the strongest programs we've seen. And it effectively shows up in their return. They've got a strong performance. They've driven shareholder return as well. And so they really excel. There's a great example of a company that's doing a good job protecting their main business.
Great example, and it's one of our holdings that we hold as well. So, and then another question I have for you is around boardroom diversity that we have wanted to see, and in California now there's a law in place to mandate that over time. But apart from any kind of policy like that, can you
I lost you there for a second, but we're talking about, aside from policy, how can we engage companies to promote diversity at the corporate level? It sounds like that was the question.
Yep, that was it.
So a couple things, and actually there are a couple of European countries that have it mandated, so California kind of took that playbook. It's interesting. I'll give you a couple of examples that we think. So over 15 years ago, Calvert founded what's called the Calvert Women's Principles, which is very interesting. So it's a global organizational handbook on diversity issues for an organization. We actually donated that to the United Nations, which became the Global Compact on Women. So that was our thought leadership at Calvert. That was actually first adopted in San Francisco, where I live, as the first city to adopt it across the board. And so putting into place different guidelines. So using these principles to really think through, I think is a start. Now over 2,200 organizations and cities across the world have adopted these women's principles, which is really cool. That was kind of born or coming out of the Calvert research system 15 years ago. The other thing that we can do, and so we don't think that just a cursory diverse, one single diverse person on a board is really going to cut it. If you had just one objective as an investor that said, I only want to invest in companies that at least have one female on the board, well, you'd invest in the entire S&P as of June of last year. The last S&P company finally added a woman to their board after 15 years of holding out, right? So now you basically have it. And our thought, that's not enough at Calvert. So we engage companies. So I'll give you an example. Over the last 5 years, we've engaged 91 companies on diversity at the board level. And now today, 77 women and 15 minorities are on boards of those companies on behalf of the work that we've done on behalf of our clients. So promoting true change. We're also part of a group called the 30% Coalition, where the goal is to get 30% diversity at the board level, because that's really where it unlocks corporate performance from what we've found. And so we won't even vote a proxy to support a nominating member of a committee or a board unless they've achieved 30% diversity at the board level. Those are a couple of different examples that we take very seriously.
We're right coming up on the hour, and I don't see that we have any additional questions. But what I'd like to say, first of all, thank you, Andrew. Thank you, Dory, for your participation as a client. This is something incorporating this into our portfolios. And I would ask you to just have a conversation with us as our clients. If this is of interest to you, let's have that conversation so we can implement that for you. And Annie, are you on the line? Just I'll let Annie say a few words, and then Dory, once again, thank you for your help and in putting this together. And Annie, if you're unmuted, any closing thoughts?
I'm unmuted, yeah. Yeah, thank you so much, Andrew and Dory. We appreciate you guys being with us today. I do have a quick question for you, Andrew. You mentioned that you guys do invest internationally. How do you guys ensure that those international companies are holding up your standards of ESG?
Well, that's the research function that comes in. It's very interesting. So companies have gotten a lot better at kind of filling out surveys. So that's part of that 9 out of 10 companies that provide us with ESG information. Our job as a very large and robust research team is to actually jive that, to not just take what a company says, but are they really executing in alignment? And so an example is, think about product safety with a certain consumer bank that might be based up here where I live. They've been saying that they're sorry to investors and customers for a few years because they had a period and a pattern of really kind of not treating their customers as best as they could. No bank has a policy that they want to defraud their customers, but there was incentives and there was instances at this particular bank, a pattern of abuse that, we call that a circumstantial review. So you look at the structural scores of what companies are reporting, but then you do a circumstantial review to really understand what companies are doing in real time. You kind of verify those against each other, and that's where you decide on whether you would invest in that company or not. So that's part of our research process.
Wonderful, thank you. I don't have any further questions, Loreen, unless you do. I think that we're all set. And again, thank you both for hosting this call.
Thank you all so much. And please reach out to Loreen with any questions you might have or resources that we can share with you. Really appreciate it.
Wonderful. I think we may have lost Loreen's connection, but thank you all for joining us today. We appreciate you being on the call, and we look forward to answering any other questions you might have. Thank you, everybody.